So everyone watching will want to know exactly how they can reduce their tax bill. What practical tips can you offer us?
Okay, the first thing is we avoid tax. We never evade tax because
Absolutely.
the latter can get you into a lot of trouble. But there are plenty of ways to avoid tax which are totally legitimate, totally legal, and they can help you avoid paying capital gains tax and dividend tax. Now, HMRC offers tax wrappers, tax efficient wrappers if you like, and basically these tax wrappers are essentially tax rules that wrap around your investment and offer you different types of tax perks, I suppose. The most well-known one will be the ISA, but there's also a type of pension called a self-invested personal pension, or SIPP, that can be quite handy as well. If we start with ISAs, now you can invest £20,000 a year, as we've said previously, and any gains that you make in there, whether that's capital gains or dividends, are all tax-free, which is absolutely lovely.
So talk to us about SIPPs. Which taxes apply here?
They're a bit similar to ISAs in that you don't have to pay capital gains tax or dividends tax. But the best thing about SIPPs really is that you get a bit of a tax boost from the government, which will contribute to your pension, because the government wants everyone to save for old age. So it offers us an incentive which is linked to the income tax that you pay. The government won't keep topping up your pension though, regardless of how much money you put into it. There's a cap of £40,000 that your allowance each year. I mean, that's still hugely generous, so we don't need to worry too much.
Yeah.
But there is a catch. You can't take the money out until you're 55. The money you take out after the 25% tax-free allowance in your retirement, that's then taxed as income. So the government does get its money back somewhere.
Okay, so we know that we can reduce our tax liability using an ISA, but talk to us about the difference of someone that contributes that £20,000 versus someone that isn't using an ISA.
Okay, so if we take our two investors, they're each investing £20,000 a year, which is the limit you can put in an ISA. One's putting their money into an ISA, the other one's just putting it into the stock market, so they're going to be liable for capital gains tax and dividend tax.
Great, so by way of an example, and to keep things simple, let's assume an annual dividend yield of 4% plus capital growth of 6%, again on an annual basis, which gives you an annual return total of 10%. Let's also assume they're reinvesting their dividends minus taxes.
Yep, I mean, in the early years of investing, it doesn't really matter whether you're in an ISA or not, because your allowances are generous enough that they'd cover all the returns that you'll make anyway. To push the point home, if we look at sort of how our investors get on, we go 15 years down the line, and our person that's invested in an ISA, they're going to be 17% better off than the person who didn't use an ISA, and that's equivalent to about over £100,000. And now that that is some difference, isn't it? That's a very hefty deposit. It might even be a whole house if you live outside London.
Yeah, and of course compounding is a powerful thing. Any money taken out of that portfolio, you're losing the compounding interest you would have made if it was invested. Utilising
pensions and ISAs is absolutely the way to go. You've got huge allowances there, so use them up. Make sure you're not paying too much tax and you're making the most out of your investment, keeping the money in your pocket rather than putting it in HMRCs.